Have you ever looked at a company's, their financial report and seen profits going way up?
Yeah, happens all the time.
But then you check their stock price or just their overall market value, and it seems to be, shrinking.
Or going nowhere. Yeah, it's confusing.
Right. Or maybe you've wondered how business leaders make those really big decisions, the ones that are meant to grow a company for the long haul, not just, hit some quarterly target.
That's a key question. Long-term versus short-term.
Well, today we're taking a deep dive into something called value-based management, or VBM for short.
Mm-hmm.
Our mission with this deep dive is really to cut through the jargon, and help you understand this pretty powerful way of looking at and improving how a company performs.
Yeah, demystify it a bit.
Exactly.
Yeah.
We're going to explore where it came from, its core ideas, some pitfalls it helps you avoid, and how it's actually put into practice in the real world.
Precisely. And our insights today, they come from this really clear, comprehensive article. It was pretty much designed to break down VBM, looking at the background, key concepts, common problems, and importantly, the implementation steps.
Okay.
So yeah, we're going to try and pull out the most important bits, give you a kind of shortcut to really grasping this critical concept.
Great. So we've kind of hinted at this problem already. Profits going up, value maybe not. Where did that disconnect really start? What was the old way of thinking?
Right. To get that, we need to rewind a bit. Think back to the 1970s, maybe even earlier.
Okay.
Companies back then, they mostly measured how well they were doing using what we call profit-based metrics.
Profit-based, like what specifically?
Well, things like earnings per share, EPS.
Right.
It's basically profit per share of stock.
Right.
Or net profit margin, how much profit you squeeze out of sales.
Mm.
And another big one was return on capital employed, ROCE. That basically shows how well a company is using its money, its capital, to make profit.
Gotcha. And these all came straight from the financial statements.
Yep, directly from the accounting numbers. That was the sort of traditional way to size things up.
So for ages, those numbers were basically it, the final word on performance.
For a long time, yes, pretty much. But here's where it gets really interesting. By the 1980s, you had leaders in business strategy and performance management starting to push back.
Okay, challenging the status quo.
Exactly. They weren't debating that, increasing shareholder wealth is the ultimate goal. Everyone agreed on that.
Sure.
But they noticed this paradox. Companies could be reporting fantastic profits going up and up.
Yeah.
But at the same time, the total return to shareholders, the stock price appreciation plus dividends, was actually going down or staying flat.
Whoa. So profits up, shareholder value down, that doesn't seem right.
It wasn't right. It was this fundamental flaw they uncovered.
Yeah.
It showed that just maximizing accounting profit wasn't the same as maximizing shareholder value. In fact, sometimes chasing profit could actually destroy value.
Wow. Okay, that's a huge insight. That's the thing that really kicked off this move towards VBM then.
Absolutely. That realization was the spark.
So beyond that big paradox, what were the specific problems they identified with those traditional profit measures?
Well, there were a few key ones. First, these profit numbers completely ignored something really important: the required return of the company's capital providers, the investors and lenders. They expect a certain return on their money.
Right, the cost of capital.
Exactly. And profit metrics didn't factor that cost in. Second, they could give a really skewed picture of performance.
How so?
Because accounting rules allow for some pretty significant non-cash expenses, things like provisions. These reduce the reported profit on paper, but they don't actually reduce the company's cash. So the profit number looks worse than the actual cash situation might be.
I see. That's a big blind spot. And you mentioned they were often based on annual results.
Yeah, mostly annual.
So what does that encourage? I mean, if you're judged year by year?
Well, it often pushes managers to focus just on the short term, hitting this year's profit target.
Makes sense.
Think about it. If a manager's bonus depends on hitting a profit number and they're falling short, what might they do?
Cut costs somewhere.
Right. Maybe they cut back on, say, R&D or marketing. That bumps up the profit number this year. But it almost certainly hurts the company's ability to grow and compete in the long run. It's short-sighted.
That makes perfect sense. So it was during this period, this time of questioning, that these other ways of managing performance started popping up.
Exactly. Things like the balanced scorecard, total quality management, and of course, the one we're focusing on today, value-based management. They were all trying to address these flaws.
Okay, let's try and make this concrete. To really show the problem with those old profit measures, our source uses this example, right? a made-up company, Omega Co?
Yeah, Omega Co. It's a public company, got different divisions. Let's look at two, Alpha and Beta. They're run as pretty independent investment centers.
Okay. And Omega's overall cost of capital, the WACC, is 13%. That's the benchmark return they need to earn.
Correct, 13%. Now, Division Alpha, it's what the BCG matrix would call a dog. Low market share, low growth market, not great.
Right, struggling a bit.
Yeah. Its current ROCE, that profit measure, is only 5%, way below the company's 13% cost of capital.
Ouch.
So the manager there, who's judged on ROCE, gets a chance to invest in a project. This project will actually improve her division's ROCE from 5% up to 7%.
Okay, 7% is better than 5%, so she takes it.
She accepts the project, yes, because it makes her division's key metric look better.
But wait, 7% is still way less than the company's 13% cost of capital.
Bingo. That's the critical point. While the project boosted Alpha's profit and its ROCE, it almost certainly did not earn back that 13% hurdle rate. So even though it looked like an improvement for Alpha,
it was probably destroying overall company value.
Very likely, yes. Eroding value.
Okay, now what about the other division, Beta?
Beta. Beta's a star, according to BCG. High growth market, high market share, doing really well. Its current ROCE is a very healthy 21%.
Nice. Much better.
Much better.
Okay.
Now, the manager of Beta gets an opportunity, a new project. But when she calculates the impact, adding this project's profits and investment would actually cause her division's overall ROCE to fall slightly, from 21% down to 19%.
Okay, still a fantastic return, 19%, but lower than 21%. So what does she do?
She rejects it, because accepting it would make her key performance metric, ROCE, go down.
But hold on, even at 19%, that project's return is still well above the company's 13% cost of capital, right?
Absolutely.
Yeah.
That's the eye-opener. This project Beta rejected, it might have been a fantastic investment for Omega Co. overall, creating significant value, but it got turned down.
Wow.
See the problem? Both managers moved decisions based purely on that accounting profit measure, ROCE, not on real value. They ignored cash flows, tax effects, and crucially, the impact on the company's actual value.
That's classic goal incongruence, isn't it? The division goals didn't align with the overall company goal. In both cases, decisions that looked logical based on the metric might have actively hurt the company's wealth.
Exactly, a huge blind spot.
So how does VBM fix this? How does it address that kind of misalignment we just saw?
Right, that's the core question. VBM starts with a different definition of value. At its heart, a company's value isn't just profit. It's determined by its discounted future cash flows.
Okay, future cash flows discounted back to today's value.
Precisely. And value is truly created only when the cash flows you get back from the capital you've invested, when those returns exceed the expected returns of the people who provided the capital.
Which is measured by that WACC, the weighted average cost of capital.
Exactly. If you're earning more than your WACC, you're creating value. If you're earning less, like Division Alpha's project, you're destroying it. That's the fundamental idea of value in VBM.
Okay, so it's a completely different starting point compared to just maximizing profit. VBM puts maximizing shareholder value as the number one overarching goal for the company.
Yes, it's a total shift in the primary objective, from profit to wealth.
And how does it make that happen? It can't just be a slogan.
No, definitely not. To achieve that goal, VBM works to align the company's entire system, its strategy, its objectives, its day-to-day processes. Everything gets geared towards generating shareholder wealth.
How? Does it use specific metrics?
It does. It usually establishes a single, high-level organizational performance metric that reflects value creation. A really common one you hear about is EVA, economic value added. That's a good example.
EVA. Okay. And then you mentioned value drivers. What are those?
Value drivers are key. These are the specific things, the activities that managers and employees can actually influence day to day. And crucially, these activities are directly linked, mathematically or logically, to creating shareholder value.
So it connects the big picture goal to everyday actions.
Exactly. And this is where I think VBM gets really powerful. It's not just something for the executives. It creates this framework, this line of sight, where every employee, right down to the front line, can see how what they do, their specific value drivers, directly contribute to the company's ultimate success and shareholder value.
It makes value creation less abstract, more tangible for everyone.
Precisely.
Makes it real.
Can you give an example of how those drivers might cascade down?
Sure. Think about employee satisfaction. Maybe you invest in training. Those could be value drivers. They directly impact, say, customer satisfaction.
Right.
Happier employees, better service.
Okay, makes sense.
Then higher customer satisfaction directly impacts customer retention. People stick around longer.
Yep.
Better retention then boosts revenue, which ultimately increases operating profit and thus contributes to that overall economic value, like EVA.
I see. So it flows from operational stuff like training up to strategic financial outcomes, and it covers both financial and non-financial things.
Absolutely. That's the linkage. Now, you mentioned EVA. It's important, you said, to distinguish VBM from EVA.
Yes, good point. They are the same thing, though they're often discussed together. VBM is the overall management approach, the philosophy, the system designed to improve shareholder value.
Okay, the whole framework.
Right. Whereas EVA is just one specific metric that can be used within that VBM framework to measure whether value is being created or destroyed in a given period.
So EVA is a tool used by VBM.
Exactly. And there are other similar value-based metrics too, like net present value, NPV, market value added MVA, shareholder value analysis, different ways to quantify economic value. EVA is just a well-known example of that top-level measure.
Got it. Okay, so VBM is the system, EVA is a possible metric. How do companies actually do VBM? How do they implement it? The source laid out 4 steps, right?
Yes, a pretty clear 4-step approach. Step 1 is all about strategy development.
Okay, top level first.
Yes. Starts at the corporate level. You develop a strategy where the main objective, right from the outset, is maximizing shareholder value. This strategy covers everything: operations, finance, maybe even M&A activity, buying or selling businesses.
And then the value drivers come in.
Right after.
Yeah.
Once the high-level strategy is set, you create those specific value drivers for the different business units, and really for all levels of the company.
Like the telecom example you mentioned earlier?
Yeah, that's a good illustration.
Oh, yeah.
If a business unit's objective is, say, reduce call center costs, then linked value drivers might be things like personnel costs and premises costs.
Okay.
And those could then cascade further down to operational drivers like average time per call, which affect personnel costs, or maybe equipment maintenance costs impacting premises costs. You define these drivers throughout the organization.
Okay, so you have the strategy and the drivers. What's step 2?
Step 2 is performance targets. You can't just have drivers, you need goals. So after defining the value drivers, they absolutely have to be translated into specific, measurable targets.
Right. Make it concrete.
Exactly. So sticking with that telecom example, the target for personnel costs might be specific, like an 18% reduction over 3 years.
Okay.
And for average time per call, maybe the target is to maintain an average of 6 minutes per call for this year.
And VBM connects short-term and long-term targets.
Crucially, yes. It encourages linking these operational, often short-term targets to the longer-term strategic goals. And ultimately, they all connect back up to that top-level value metric like EVA. Everything should align.
Okay, strategy, targets. What's step 3?
Step 3 is making it happen. Operational plans. Those targets we just talked about. They get assigned. They become the responsibility, the ownership of specific people.
Ah, accountability.
Yes. So a business unit manager might own that personnel cost reduction target. A customer service team leader might own the average call time target. And then you define specific operational plans, the actual actions people need to take to help those employees hit their individual targets. What steps will the team leader take to keep call times at 6 minutes? What will the manager do to reduce personnel costs?
So it gets really practical at this stage.
Very practical. It's about execution.
Okay, and the final step, step 4.
Step 4 is performance measurement. You need to track progress. Now, like a lot of modern performance systems, VBM promotes using key performance indicators, KPIs, for everyone.
KPIs, right. Measurable indicators.
Yep. And the key shift here is moving beyond just financial metrics. VBM encourages including management-driven, often non-financial metrics as well.
Like customer satisfaction.
Exactly. So while something like economic profit or AVA might serve as a short-term financial scorecard, other metrics get tailored to specific units and managers. They might be non-financial, like customer satisfaction levels, or maybe focus on the longer term, like customer lifetime value.
And this links back to how people are rewarded too, right?
Absolutely. Tying into this measurement step, successful VBM really requires linking managers' pay, their remuneration, directly to hitting targets for these key value drivers and objectives.
Okay.
That's actually a concept that overlaps with HR management ideas, like the building block model for compensation design. It has to be integrated.
And you mentioned spreadsheets playing a big role here. How does that fit in?
Yeah, spreadsheet modeling becomes a really critical tool, especially for management accountants working within a VBM system.
Why is that?
Well, think about calculating something like EVA or any value-based metric. There are tons of forecast variables involved, right? Revenue growth, capital spending, depreciation, tax rates, interest rates, loads of them.
That's moving parts.
Exactly. Spreadsheets let you build models to handle all that complexity. You can run scenario analysis. What if interest rates go up? What if revenue growth slows down? And see how different assumptions impact the value drivers and ultimately the company's overall value.
So it helps with forecasting and sensitivity analysis.
Yes, and also with consolidation. It helps combine performance metrics from all the different business units into one sort of unified financial model.
Right.
And that model can then drive dashboards, giving managers at different levels the insights they need for better decisions. Tracking things like how quickly you collect cash from customers versus paying suppliers, or the percentage of consultant time that's actually billable, or how much of your factory capacity is being used, all linked back to value.
Okay, so VBM sounds, really comprehensive, very powerful if done right. But like anything, I assume it's not always smooth sailing. Are there potential problems or challenges?
Oh, absolutely. Nothing's a silver bullet.
Yeah.
One of the biggest hurdles is often the culture shift.
The people side.
Yeah. Implementing VBM successfully usually requires a pretty significant change in the company culture. These new objectives, new ways of measuring performance, new reward systems, it can be a really big adjustment for people.
Everyone needs to buy in.
Everyone,
Yeah.
all managers, all employees, they need to genuinely understand how their specific job, their role, contributes to creating value. If that understanding, that buy-in isn't there, the whole initiative can just fizzle out.
Okay, that's a big one. What else?
Another potential challenge is the management information systems, the MIS.
The IT system.
Basically, yeah. The technology and processes used to gather and report information. Implementing VBM often means you need to capture new types of data, especially that non-financial stuff we talked about.
Like customer satisfaction data, maybe?
Exactly. Or employee turnover or process cycle times. Updating the MIS to track and report on these new metrics can be a massive undertaking.
Yeah.
Complex and often very expensive.
Right, not a trivial task. Any other pitfalls?
Well, there's an interesting one highlighted by Timothy Collar, who's a real thought leader in this space, from McKinsey. He called it value veneering.
Value veneering sounds like just putting a shiny coat on something.
That's exactly the idea. It happens when a company puts a ton of effort into the technical side. Calculating detailed cash flow forecasts, doing complex valuations, figuring out the precise cost of capital.
They do all the math.
They do all the math. But then they fail to actually change how decisions are made. They don't embed VBM into the real management processes. They don't get the decision makers involved in using this new information.
So it's all analysis, no action.
Pretty much. They've calculated value, but they aren't managing based on value. It's just a layer on top, a veneer, not a fundamental change in how the business is run.
I see. Just going through the motions without changing behavior. That's a subtle but important trap.
Definitely. You have to use it as a real management tool.
Okay, so let's sort of recap where we've been. We've really unpacked this crucial shift, haven't we? Moving away from those traditional profit-based measures.
Which, as we saw with that Omega Code example, could lead to some really strange outcomes. That goal incongruence and definitely encourage short-term thinking.
Right. And we contrasted that with value-based management. We dove into how VBM tries to fundamentally realign, everything in a company. The strategy, the goals, right down to what individual employees do every day.
All centered on one thing. Truly maximizing shareholder value, long-term value, through those specific measurable value drivers.
Yeah. The striking thing for me is how VBM provides this structured, really comprehensive way for companies to try and make sure every decision, every action is actually contributing to sustainable long-term value.
It's about looking beyond just the profit number for this quarter or this year and really understanding the underlying economic value being generated.
Yeah.
Or destroyed.
So as we wrap up, maybe a final thought for you, our listener. Considering how those traditional profit metrics could sometimes lead managers astray, that goal incongruence problem, how might rethinking your own goals, maybe personal goals, maybe professional ones, through a kind of value driver lens, how might that reveal new paths to long-term success? Paths that your current ways of measuring progress might actually be hiding?
That's a fascinating question to ponder. What are your real value drivers?